The Federal Reserve just made a decision that could devastate your retirement savings, and most Americans have no idea it's happening. While the mainstream media celebrates another rate cut, something far more dangerous is unfolding behind the scenes. And if you don't understand what's really going on, you could watch decades of careful saving evaporate in a matter of months. Let me show you exactly what I'm talking about. The Fed just cut rates again. On the surface, that sounds like good news, right? Lower rates mean cheaper borrowing, a boost for the economy, maybe even a rally in stocks. That's what they want you to think. But here's what they're not telling you. Every single time the Fed cuts rates, they're making a calculated bet. They're betting they can control inflation, manage the economy, and keep everything balanced. And right now, that bet is failing spectacularly. Here's why this matters to your retirement. When the Fed cuts rates, they're essentially admitting the economy is weaker than they want you to believe. They're trying to stimulate growth, encourage spending, keep things moving. But there's a problem. Inflation isn't cooperating. Despite their best efforts, prices are still elevated. The cost of living is still crushing middle-class families. And now, by cutting rates while inflation remains stubborn, they're creating the perfect storm for your purchasing power to get absolutely destroyed. Think about what's in your retirement account right now. If you're like most Americans, you've got a mix of stocks, bonds, maybe some mutual funds, traditional assets, the kind of investments financial advisors have been recommending for decades. And here's the brutal truth. Those assets are about to get hammered by what's coming next. Let me explain the mechanism. When the Fed cuts rates, bond yields fall. That means the interest you're earning on fixed income investments drops. Your bonds lose value. Your bond funds take a hit. And if you're retired or close to retirement, that's supposed to be the safe part of your portfolio, the part that provides steady income and protects you from volatility. But right now, that safety is an illusion. Meanwhile, stocks are trading at historically high valuations. The S&P 500 is near all-time highs, but corporate earnings aren't keeping pace. Price-to-earnings ratios are stretched, and when the Fed cuts rates in a weakening economy, it's often a signal that a recession is closer than anyone wants to admit. History shows us what happens next. Stocks crash. Retirement accounts get cut in half. And millions of Americans who thought they were financially secure suddenly realize they're not. But here's where it gets even worse. The real danger isn't just what's happening to stocks and bonds. It's what's happening to the dollar itself. Every time the Fed cuts rates, they're making the dollar less attractive to hold. Foreign investors start looking elsewhere. Central banks around the world start diversifying away from dollar reserves. And the value of every dollar you've saved starts to erode. You've probably felt this already. Go to the grocery store, fill up your gas tank, pay your utility bills. Everything costs more than it did a few years ago. That's not just inflation. That's your dollars losing purchasing power in real time. And the Fed's latest move just accelerated that process. Now, I want you to imagine something. Imagine you've spent 30 years saving for retirement. You've been disciplined. You've maxed out your 401k contributions. You've followed all the conventional advice. And then, right when you're ready to retire, you discover that the money you saved can only buy half of what you thought it would. That's not a hypothetical scenario. That's what happened to retirees in the 1970s when inflation spiraled out of control. And it's exactly what's setting up to happen again. The Fed is trapped. They can't raise rates because the economy is too weak and the government debt is too massive. Higher rates would trigger a recession and make it impossible to service the national debt. But they can't keep rates low either, because that fuels inflation and destroys the dollar's value. So they're stuck in this impossible position, making moves that look like they're helping, but are actually making everything worse. And here's what really keeps me up at night. The people making these decisions, the economists at the Federal Reserve, they've been wrong about everything. They said inflation was transitory. It wasn't. They said they could engineer a soft landing. They haven't. They said rate cuts would stabilize the economy. But all they're doing is setting up the next crisis. You know who understands this? Central banks around the world. While the Fed is cutting rates and pretending everything is fine, central banks in China, Russia, India, and dozens of other countries are doing something very different. They're buying gold. Massive amounts of gold. Record amounts of gold. In fact, central bank gold purchases hit the highest levels in decades. Why? Because they see what's coming. They know the dollar is losing its status as the world's reserve currency. They know fiat currencies are being debased, and they're protecting themselves. Think about that for a second. The institutions that understand money better than anyone else on the planet are moving away from paper currencies and into physical gold. They're not buying stocks. They're not buying bonds. They're buying the one asset that has preserved wealth for thousands of years, and they're doing it quietly, systematically, month after month. Meanwhile, the average American retiree has zero gold in their portfolio. They're sitting on a pile of paper assets that are vulnerable to everything I just described. And when the next crisis hits, when the dollar loses more value, when stocks crash and bonds fail, they're going to be completely exposed. Now, I know what some of you are thinking, but gold doesn't pay dividends. It doesn't generate income. It just sits there. And you're right, gold doesn't produce cash flow. But here's what it does do. It maintains purchasing power. When currencies collapse, gold holds its value. When stock markets crash, gold often rises. When inflation destroys the value of paper money, gold protects wealth. Let me give you a specific example. Back in the early 1970s, gold was trading around $35 an ounce. The dollar was still technically backed by gold, but that was about to change. Then President Nixon closed the gold window, ending the dollar's convertibility to gold. What happened next? Gold went from $35 to over $800 by 1980. That's a 20-fold increase. Meanwhile, the stock market went nowhere for a decade. Bonds got crushed by inflation, and retirees who held traditional portfolios watched their purchasing power evaporate. The people who protected themselves were the ones who owned gold. They didn't just survive that crisis, they thrived. While everyone else was panicking, they were sitting on an asset that multiplied in value. Fast forward to 2008. The financial crisis hit. Stocks crashed. Lehman Brothers collapsed. The entire financial system was on the brink. And what happened to gold? It went from around $700 an ounce to over $1,900 by 2011. Once again, gold protected wealth when everything else was falling apart. And here's the thing. We're setting up for something potentially bigger than both of those crises combined. The amount of debt in the system is unprecedented. Government debt, corporate debt, consumer debt, all at record levels. The Fed's balance sheet is bloated beyond anything we've ever seen. And now they're cutting rates again, adding more fuel to an already dangerous fire. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without triggering tax penalties. Worth checking out if that's relevant to your situation. All right, back to what's happening with the Fed. So where does this leave you? If you're holding a traditional retirement portfolio, you're exposed to multiple risks simultaneously. Stock market risk, bond market risk, currency risk, inflation risk, and the Fed just made all of those risks worse with their latest decision. But here's what most people don't understand about gold. It's not just a hedge against one type of risk. It's insurance against systemic failure. When the entire financial system is built on debt and paper promises, gold is the one asset that exists outside that system. It's not someone else's liability. It doesn't depend on a government's promise or a central bank's credibility. It's real, tangible wealth that you can hold in your hand. And right now, we're seeing something remarkable happen in the gold market. The price has been climbing steadily, but it's not because of retail investors. Most Americans still aren't paying attention to gold. The buying is coming from central banks, from sovereign wealth funds, from institutions that manage trillions of dollars. They're accumulating gold quietly, consistently, without making headlines. Why does that matter? Because institutional buying creates a floor under the price. When central banks are buying, they're not going to panic and sell at the first sign of trouble. They're buying for strategic reasons, for long-term wealth preservation. That creates stability and upward pressure on prices. At the same time, the supply side of the gold market is getting tighter. Gold mining production has been relatively flat for years. It's getting harder and more expensive to find new deposits. The easy gold has already been mined, and while demand is surging, supply isn't keeping pace. That's a recipe for higher prices. But here's where it gets really interesting. Most of the gold trading that happens in the world isn't physical gold, it's paper gold. Futures contracts, ETFs, derivatives. There's far more paper gold trading than there is actual physical gold in existence. And that creates a massive vulnerability in the system. Think about it like this. Imagine a bank that issues 100 deposit receipts but only has $10 in the vault. As long as everyone doesn't try to withdraw their money at the same time, the system works. But the moment people lose confidence and demand their money back, the whole thing collapses. That's essentially what's happening in the gold market. There are far more claims on gold than there is actual gold to back those claims. And when the next crisis hits, when people start demanding physical delivery, when they want real gold instead of paper promises, we're going to see a squeeze unlike anything in modern history. The price of physical gold could explode higher as the paper market breaks down and people scramble to get their hands on the real thing. This isn't speculation. We've already seen glimpses of this happening. During the pandemic, there were periods where you couldn't buy physical gold at anywhere near the spot price. Premiums on coins and bars skyrocketed. Dealers were sold out. The disconnect between paper prices and physical availability was stark. And that was just a preview of what's coming. Now, let's talk about what this means for your retirement specifically. If you're in your 50s or 60s, you don't have time to recover from a major market crash. If your portfolio gets cut in half, you can't just wait 10 years for it to come back. You need that money now or soon. That's why the Fed's actions are so dangerous for people approaching retirement. They're creating conditions that could devastate the exact demographic that can least afford to take losses. And it's not just about market crashes. It's about the slow, steady erosion of purchasing power. Even if stocks don't crash, even if bonds hold their value, if inflation continues to run higher than your returns, you're losing ground every single year. Your nest egg might look the same on paper, but it buys less and less in the real world. That's where gold comes in as a strategic allocation. I'm not saying you should put everything into gold. That would be reckless. But having a meaningful position in physical gold, maybe 10 to 20% of your portfolio, gives you protection against the scenarios that could destroy traditional assets. It's insurance. And right now, that insurance is looking more valuable than ever. Let me paint you a picture of what could happen over the next few years. The Fed continues cutting rates, trying to keep the economy afloat, but inflation doesn't cooperate. Prices keep rising, the dollar keeps weakening, foreign countries accelerate their move away from dollar reserves. The national debt keeps growing, making it impossible to raise rates without triggering a debt crisis. Meanwhile, stocks are overvalued and vulnerable to any economic shock. Bonds are paying yields that don't keep up with inflation, and retirees are stuck in the middle, watching their purchasing power decline month after month. That's the scenario we're heading into, and the Fed's latest rate cut just made it more likely. But here's the opportunity. Right now, before the crisis fully unfolds, you still have time to protect yourself. Gold is still accessible. You can still buy physical gold and get it into a retirement account. You can still position yourself the way central banks are positioning themselves, but that window won't stay open forever. When the crisis hits, when everyone suddenly realizes they need gold, the price will be much higher and availability will be much lower. The time to act is before the crowd figures it out. That's always been true with gold. The people who benefit are the ones who move early, who understand what's coming before it becomes obvious to everyone else. And here's something else to consider. Gold isn't just about protecting against downside risk, it's also about participating in upside potential. If we see a major repricing of gold relative to paper currencies, if we see the kind of move that happened in the 70s or after 2008, the gains could be substantial. You're not just preserving wealth, you're potentially growing it while everything else is falling apart. Think about the psychology of what's happening right now. Most people are complacent. The stock market is near highs. The Fed is cutting rates, which sounds positive. The mainstream narrative is that everything is under control. But underneath the surface, the fundamentals are deteriorating. Debt is exploding. The dollar is weakening. Inflation is persistent. And the Fed is out of good options. This is exactly the kind of environment where gold shines. When there's a disconnect between perception and reality, when the crowd is complacent but the risks are mounting, that's when you want to be positioned in assets that protect against systemic failure. And there's no asset that does that better than physical gold. Now, I want to address something important. A lot of people hear about gold and they think it's too complicated or too risky. They've been told their whole lives to stick with stocks and bonds, to trust the system, to believe that everything will work out. And for a long time, that advice worked. But we're in a different era now. The rules have changed. The risks are different. And the old playbook doesn't work anymore. Getting gold into a retirement account isn't complicated. It's actually straightforward if you know the process. You can roll over funds from an existing IRA or 401k into a gold IRA without triggering taxes or penalties. The gold is held by a custodian, stored in a secure vault, and it remains part of your retirement account. You get the tax advantages of an IRA with the protection of physical gold. It's the best of both worlds. And here's what's crucial. It has to be physical gold, not a gold ETF, not a gold mining stock, not a gold futures contract. Physical gold that you own, that's allocated to you, that exists outside the banking system. Because when the crisis comes, when the paper markets break down, physical gold is what will matter. The Fed's latest rate cut is a warning sign. It's telling you that they're worried about the economy. It's telling you that they're willing to sacrifice the dollar's value to try to keep things afloat. It's telling you that the risks to your retirement are real and growing. The question is, are you going to heed that warning, or are you going to ignore it and hope for the best? History is clear on this. Every time a major currency crisis has unfolded, every time a financial system has collapsed, the people who owned gold were protected. The people who didn't own gold suffered devastating losses. We're not talking about ancient history here. This has happened repeatedly in modern times. In Weimar Germany, in Zimbabwe, in Venezuela, in Argentina. When currencies fail, gold preserves wealth. And while I'm not saying the dollar is going to collapse tomorrow, I am saying that the Fed's policies are pushing us in that direction. They're debasing the currency. They're destroying its purchasing power. They're making it less attractive for the rest of the world to hold. And at some point, that process reaches a tipping point where confidence breaks and things unravel quickly. You don't want to be caught unprepared when that happens. You don't want to be the person who realizes too late that their retirement savings are denominated in a currency that's losing value rapidly. You want to be the person who saw it coming, who took action, who protected themselves with real assets. So here's what I want you to do. Take a hard look at your retirement portfolio. Ask yourself honestly, if we see another financial crisis, if we see persistent inflation, if we see the dollar lose significant value, how protected am I? If the answer is not very, then you need to make changes. You need to add some gold to your portfolio, not as a speculation, not as a trade, but as insurance against the very real risks that the Fed just made worse. The information is out there. The evidence is clear. Central banks are buying gold for a reason. Institutional investors are moving into gold for a reason. And that reason is simple. They see what's coming. They understand that the current system is unsustainable. They know that paper assets are vulnerable, and they're protecting themselves accordingly. You have the same opportunity. You can make the same moves that the smart money is making. You can position yourself to not just survive the coming crisis, but to potentially thrive during it. But you have to act. You have to make the decision to protect your retirement before it's too late. The Fed just put your retirement at risk. That's not hyperbole. That's reality. Their rate cut, combined with persistent inflation and a weakening dollar, creates a perfect storm for traditional retirement portfolios. But you're not helpless. You have options. You can protect yourself. You can own gold. You can ensure that decades of hard work and careful saving aren't wiped out by forces beyond your control. Don't wait until everyone else figures this out. Don't wait until gold is twice the current price and hard to find. Don't wait until your retirement account has already taken massive losses. Act now, while you still can, while gold is still accessible, while you still have time to position yourself properly. Your future self will thank you for having the foresight to protect what you've worked so hard to build.